Well, one top investor is questioning the street's enthusiastic response to the jobs report. CNBC contributor Peter Boockvar is chief investment officer at Bleakley Financial Group. Peter, good to have you with us. Were you surprised at the market reaction? I mean, the market seems to want to believe the best case scenario here.
Well, it was interesting. Once that data hit, the S&P futures went up like 50 points. And I'm going through the numbers, and bonds sold off too. So I'm trying to square our stock celebrating maybe weakness, because when you include the revisions, but then what's the bond market looking at? So there wasn't really a clear message with the 10-year closing at 4.5%. So I was somewhat confused. I'm a little more clear on the actual number. If you take the downward revisions of 95,000, compared to what the market saw at 829, we really only added 44,000 fresh jobs because of the number itself minus the revision. Then you had the household survey that fell almost 700,000. You had the highest number of people working part-time that want full-time work since April 2019. But then you had wage growth that was good. So there were a lot of cross currents. But I think overall, the pace of job hiring is slowing. I would not ignore what ADP also said on Wednesday. But the bond market is resiliently higher in terms of yields because they don't believe that the Fed is going to really cut. And even if the Fed cuts, that doesn't mean long rates fall in conjunction with that. So overall, it sounds like you're reluctantly acknowledging that the data right now is supportive of where we are in the markets. The data, to me, still remains very uneven. Okay. You have the pockets of strength with upper income spending, anything related to AI spend, and up until we'll see what this budget looks like, government spending has been a massive support to economic growth over the past couple of years. But that rate of change is about to slow. On the weakness side, we know manufacturing's in a recession. Lower to middle income consumers are stretched. The pace of existing home sales at 30-year lows, with the population more than 25% higher. So it's very mixed from what I'm seeing. So the rubber's going to hit the road. Yeah, and then we'll have to see what the impact is in the back half of the year with tariffs, because we know businesses, not me saying it's what they're saying, dealing with all the stress and juggling so many balls with tariffs if you are, getting stuff from overseas. Are you optimistic about a China deal, which supposedly was reached yesterday, but apparently is not reached because it's the same deal as before, and there might be another deal in the coming? I don't even know what a deal is going to look like. And when you look at the one in 2018, where they're just going to buy more soybeans and LNG, is it going to be any different? I don't know. So I don't know what one looks like. But I think both sides saw their pain points, us on rare earths, them on technology, among other things. Us with small businesses getting stuff from their manufacturers, their manufacturing base, wanting to sell it to us. So where this settles out, I don't know, but I don't know.
I thought the bond market reaction was more interesting than the equities. And I know you've kind of said that. You at least saw both sides of it. They were inconsistent because, arguably, the expectations were it was going to be a weak number. So if anything, I think bond expectations were, and the negative here is that the move to 450 gets you back to a place where you're near on a breakout on the 10-year. But for the right reasons or not. In other words, if the 10-year was only around 439 going into this print on fear of a weak number, the market is positioning for, and I think the economic news could have been arguing for, less buoyancy on the economy, but more concern on long rates. So it's a long way of saying I thought the bond market's reaction would be concerning if you're an equity investor that thinks, because, hey, look, I want to see the bond market sell off. In other words, yields go higher on economic strength. But this wasn't that strong.
Right. There is a global aversion to taking much duration risk. We're seeing that in Japan. We saw it in the UK. The bond police are driving around global bond market neighborhoods looking for those countries that need to issue a lot of bonds and that have too much debt. And I do think, to your point, it is very noteworthy that bond response today to what was under the hood a softer jobs number. But it is a global thing. Investors don't want to lend money to governments that are over indebted for 30 years, or 10 years for that matter. So I think that this is a multi-year situation that we're in. We had a 40-year bull market in bonds with lower interest rates, and we're a few years into this bond bear market. And I don't think you can just look at U.S. growth and inflation and then come up with a 10-year yield. There's a broader global thing going on here with sovereign bonds. So 6,000 is an important level that we crossed once again today to the upside.
where are we at the end of the year, in your view, given all this backdrop and given the uncertainty? And I know that's a very unfair question because even companies can't give an outlook. But what's your outlook for the markets?
You got one anyway.
All I'm confident in for the rest of the year is that international markets are going to continue to outperform U.S. markets.
Okay.
The foreigners are rethinking the amount at which they want to own U.S. assets. So that reallocation outside the U.S. is going to be reflected in a weak dollar. And where the S&P goes, I don't know. But international markets, this outperformance is not just a one-quarter thing. It's potentially a multi-year thing.
All right. Peter, thank you. Great to see you.
Thank
Peter
you, Melissa.
Boockvar.